There is a version of you right now who is losing money to someone who thinks a candlestick chart is about wax. In the last 5 years, the least experienced traders on the internet have outreturned most professional fund managers. By the end of this video, you'll know exactly why that keeps happening and why it's about to flip on all of them. Stick around, because your own portfolio might be one bad habit away from doing the same thing. Let's meet the guy who accidentally proves this entire theory. Meet Jordan. 18 months into trading, which in market terms is basically still wearing a diaper. Jordan's account is up 31% this year after a lucky bet on an AI-themed penny stock. Jordan now genuinely believes he has a system. His hobbies now include energy drinks, trading memes, and explaining generational wealth to co-workers who did not ask. So naturally, Jordan decides it's time to trade with borrowed money. He applies for margin trading and rounds his income up by a reasonable amount. 3 months later, Jordan is fully leveraged on a single tech stock's short-term options. His entire strategy is buy the dip, even when there is no dip, and there was never going to be a dip. His risk management plan is, and I quote, vibes. Meanwhile, his roommate is quietly asking why the shared grocery fund is $1,300 short. Then the central bank raises interest rates, and Jordan's system meets reality. His portfolio drops 58% in 11 weeks. His roommate's new hobby is Googling how to unfriend someone who calls himself a hedge fund. So here's the real question. This video is actually about why did reckless investors like Jordan outperform for years before this happened? The answer starts with a psychology concept that explains almost every overconfident person you've ever met. It's called the Dunning-Kruger Effect. In plain terms, the less you actually know about something, the more confident you tend to feel about it. Then, once you actually learn the subject, your confidence usually crashes before it slowly climbs back up for real. In markets, that means beginners often feel the most certain right when they understand the least. And for the last several years, that overconfidence has been getting paid. Since 2020, almost any stock you bought would have made you money. And if you were the most overconfident, most reckless person in the room, you likely beat the market. Not despite that, but because of it. Careful textbook investors were out here, checking earnings reports and comparing valuations like it's still 1995. The investors actually winning were buying companies trading at hundreds of times their earnings on pure momentum. They were riding trends with less logic behind them than a dog wearing sunglasses becoming a $100 million coin. And they were pitching every single one of those trades to anyone who would listen. If you zoom out even further, the bigger reason becomes obvious. We have been living through one of the longest bull markets on record, roughly 17 years of the market grinding, mostly upward since the 2009 crash. Total returns over that stretch, well north of 700%. When almost everything goes up for almost 2 decades, the loudest, most aggressive bets tend to go up the fastest. So a wild, undiversified, high-risk portfolio hasn't just survived this market, it has thrived in it. Now obviously no bull market lasts forever, even if this one has felt like it might. So the real question becomes, how do you actually get ready for it to end? Before we get there, quick word from today's sponsor, because even reckless investors need somewhere safe to put their winnings. Okay, back to the chaos. There are really only 2 honest ways to prepare for a downturn. Option 1, sit mostly in cash, the way famously patient investors like Warren Buffett have been doing. The problem is, sitting in cash is slow, boring, and it means missing out on any further upside. Which brings us to option 2. Keep riding the wave and figure out who to blame when it eventually breaks. When the correction eventually comes, there's always a long list of convenient scapegoats. The central bank, the politicians, market manipulation, anyone but the leverage you personally chose to take on. Because apparently, taking a loss like an adult went out of style right around the same time as flip phones. Which finally brings us back to the real answer to today's question. Reckless investors have been winning because they hold the exact type of stock this market has rewarded most. High volatility stocks, the ones that swing far more violently than the market itself. To understand why, we need to talk about a number called beta. Beta measures how hard a stock swings compared to the overall market. Think of the overall market as a regular trampoline bounce, and a high beta stock as the same jump. But on a trampoline, someone illegally souped up. Here's a real example. A well-known tech stock has a beta of around 1.33. That means it's roughly 33% more volatile than the market as a whole. So if the market climbs 2%, that stock is expected to climb about 2.7%. And if the market drops 2%, That same stock is expected to drop about 2.7%. On the way up, that extra swing looks like a superpower. A portfolio full of these high beta stocks, which honestly describes most beginner portfolios, will outrun the overall market on the way up. And that's exactly the environment Jordan bragged his way through, right before his account cratered. But on the way down, that same trampoline turns into a much longer fall. A high beta portfolio doesn't just dip in a downturn, it gets absolutely flattened by it. In a rising market, Jordan looks like a genius who cracked the code early. In a falling market, Jordan becomes a cautionary screenshot that strangers repost for entertainment. The uncomfortable truth is that being reckless has quietly been the winning strategy of this entire market cycle. Not because reckless investors are secretly brilliant, but because the market itself has been rewarding exactly the kind of behavior that Dunning-Kruger predicts: overconfidence, concentration in one or two bets, and zero patience for anything that sounds like diversification. The problem is, none of that behavior is actually a strategy. It's just timing that happened to work. And timing has a nasty habit of running out exactly when you least expect it. So here's the actual takeaway. And it's simpler than most finance channels want to admit. High beta bets can absolutely make you look like a genius in a market like this one. But the same math that inflates your gains on the way up is quietly loading the exact same multiplier on your losses. Beta doesn't care whether you're right. It just amplifies whatever direction the market decides to go. So before you brag about beating the market this year, it's worth asking a simple question. Did you actually make a great call? Or did you just happen to own the most volatile stocks during the best market in decades? Because those are two very different things, and only one of them survives a downturn. As for Jordan, he's currently rebuilding, this time with an actual plan instead of a vibe, which honestly might be the smartest trade he's made all year. So here's the question this leaves you with. When this 17-year bull run finally does turn, will your portfolio be the trampoline, or will it be the ground? If you're not sure, that's probably worth figuring out before the market decides for you. If this helped you see your own portfolio a little differently, subscribe, because the next video breaks down exactly how to check your own beta in about 2 minutes.